crude here down, look, some 0.6%. Similar moves for WTI. And of course, we're seeing that because we're seeing Saudi Arabia slashing prices, of course, for Asian buyers. We also saw Bitcoin there rising to some 52,000. We also see El Salvador making it a legal tender tomorrow. And there's a bit of a social media movement at the moment to try and get people to buy Bitcoin. You were talking about aluminium. Look at that here. I've got a big, I think, 20-year chart for you here. It's hit a decade high. And this, of course, after that political unrest in the West African state of Guinea. We're looking at Oleg Deripaska, that's the owner of Russell, saying this is a really concerning thing for the markets. Of course, the concern is about supply of bauxite, that key, of course, to making aluminium. Francine.
Emma, thank you so much. Anna Chandra there with some of the moves that we should be watching on the markets. Now, look at what's ahead this week. First of all, President Biden likely making his choice this week on whether to renominate Fed Chair Jay Powell to a second term. Tomorrow, El Salvador becoming the first country to accept Bitcoin as legal tender. On Wednesday, Dallas Fed President Robert Kaplan holds a virtual town hall discussion. On Thursday, we get the latest ECB rate decision and press conference from Christine Lagarde. So actually, after a quiet day today, it's going to be a pretty packed week for the rest of the week. Tom Kinmoth, ABN Amro fixed income strategist, joins us now. Tom, I have a million questions on the jobs report. All right, do you take it as a positive because there was wage pressure, so it's healthy because wages are going up? Or does the number mean that actually the economy could be on its knees and we haven't realized yet?
Yeah, I think labour markets are absolutely key. Obviously, in the US, there it's still a little bit vulnerable. We still have the impact of Delta variant beginning to play a larger role. Within Europe, for example, short-term labour's force numbers are still very high. We've had a 3 million increase in the population who left the labour market. And for us, that's one of the key reasons, especially this Thursday, that the ECB will draw to as the reasons why they'll continue to be very dovish, continue to support economies going forward. We're basically positioning for a lot lower for longer scenario, especially in Europe.
Tom, so what does it mean actually for, does it change your view of when Fed starts tapering? And they've told us and told us and told us, tapering does not mean rate hikes.
No, I think that's the key. Overall, there's going to be a very dovish sentiment throughout the world at the moment. Countries really want to overheat, if possible, for a number of periods, and that will then begin to play through. Obviously, every bit of data that's not as strong will continue now to see the second round effects of Delta, which wasn't planned for before. So we're even dovish then on the Fed side that they don't want the markets to get ahead of themselves. They are probably pricing in too much already at the moment, and we're positioning for far lower for longer on that side. Even in the last 3 months, the market's beginning to adjust lower, and we continue to see these labour markets not coming through as strong as anticipated by the market.
Tom, what does it mean for treasuries then?
We think lower overall. The market is pricing in too much overall. We think the first rate hike could be in 2023. The ECB even later, especially in terms of this Thursday. The ECB, we think, will remain with heavy stimulus still coming into the market. And obviously, we've got a huge problem here in Europe as well, that corporate financial conditions are still very, very fragile, begun to deteriorate even in some big countries, such as France. And looking at the longer term, though, debt serviceability of both countries everywhere will be really important. Interest rates have dropped so much, especially in Europe, that in Italy, we expect interest rate costs as a proportion of GDP just to be 2%, which is very low.
But Tom, what does that mean? So first of all, what are you expecting from the ECB? And we saw this, note by some of the banks saying that if you look at policy divergence, or actually when you're looking at, for example, the convergence of Italian, bonds with German bonds, they'll just get narrower and narrower. I mean, does that make sense?
In the end, it's compression. So if we have more ECB stimulus coming into the market, we're going to have spreads very, very low across the board. And we'll continue to see Italians performing. We expect Bund at minus 50 basis points around the deposit rate this year and next year. So that's well out of consensus. And then also we'll have that ability. So we've got the market compressed heavily, but also the chance of credit spikes is quite limited. Because all the countries are being helped at the same time, debt serviceability, as mentioned, is lower. So we essentially think the ECB is going to be here for a lot longer. We expect TLTRO extensions, and the market at the moment wishes for more inflation. But if you look at core inflation, it hasn't been going anywhere. Previously, after crisis, as it drops, we expect it to pull back into next year and us to be in this a lot lower scenario than it's priced in at the moment.
Tom, overall, what would a policy mistake look like? So do you worry more about deflation or rampant inflation?
Deflation on that side. There's still a lot of variables going. Before the crisis, especially in Europe, there was a lot more worries on that side. Central banks are so closely involved now with the markets and quarterly data and everything. The chances that they would accidentally raise too quick looks quite slim. As said, they will want 2 or 3 periods, 2 or 3 quarters of the market exceeding, for example, a 2% inflation rate, which would be excessive. So for us, we're still on that dovish side, still think more stimulus, and in purely looking at core inflation, there is a lot more to do.
Tom, overall, I mean, a couple of questions, or maybe, one killer question when it comes to supply chains. Are we underestimating the longer term impact some of these supply chain issues could be here to stay?
I think how the Delta variant now progresses in China in the next few months will be absolutely crucial. We've seen the UK obviously rebound very quickly in terms of restrictions. That looks very good on the supply and demand side. The question is, which way does it go? We're at a fork now in the next couple of months, as we saw last year. We'll begin to see a lot more pressure put on that side. Is there more restrictions? And at the moment, it looks okay. But if it begins that we have more restrictions, especially globally, then that would begin to weigh more on supply chains. So more temporary factors at the moment.
Right. But Tom, where do you see it first? So if this is temporary for the moment, if it gets ugly, how do you see it?
I suppose we begin to see it just coming through on disposable income goods, on large items, ticket items. Obviously, we've had a lot of discussion there on microchips and everything on that side. But when we begin to see huge import and export imbalances because of that, that's when it will really begin to hurt. Obviously, Europe, heavily export-driven GDP on that side. US, a bit less export-driven, but still really important on that side. And it's all tied to now how the next few months go. How can economies, how will they deal with Delta rising, especially in the Northern Hemisphere? What will occur on that side?
Okay, now there's, I love some of the research notes, Tom, that were kind of off the beaten track. I know you look at, vaccine supply bottlenecks clearing up. But again, is there anything that you're seeing in the economy that should make us worried about where fixed income goes from here?
Our base case now is for rates to stay very low at their current levels. Carry has become king, and within the fixed income world, credit is king. That's the only area that's given a positive return. We're positive on high yield credit. Obviously, there are some members that are very worried about the long end. With our very dovish view, we're positive with the long end, like to get the duration on that side. And so overall, the biggest worry, ironically, to credit and fixed income is an improvement in conditions. If we suddenly get excessive growth, excessive inflation, then the long end, say over 8 to 10 years, will underperform. And that's what's happened with the ECB being so heavily involved in markets that actually when we get good performance, it's bad.
What do you do with China right now? So again, one of our top read stories today on the Bloomberg terminal is trying to figure out what they mean with common prosperity and what happens in crackdown. There must be a fixed income angle to this. What are you looking at?
Essentially, is it going to offset the strong strength that we've seen in China? Is divergence or a greater tax system going to impact this huge growth and ability it's got in China? And the answer for us, I suppose, is no. That despite these smaller rules and changes, and we've seen it obviously on the domestic companies, the huge domestic user base is obviously helping excessively. And at the moment, we just don't foresee that a policy change there would be able to globally impact everything in the markets, especially in terms of where the central banks are going in terms of interest rate rises. China has managed the economy very closely, will continue to do so, and will make sure that the wheels do not fall off by any of their big changes.
Tom, thank you so much. Tom Kinmuth, their ABN Amro fixed income strategist. Now,